Welcome back to Silver Dispatch. I'm OG Peter. Something significant unfolded on Friday, May 15th, 2026, and almost every major financial outlet walked right past it. They were too busy covering trade summits in Beijing and Senate votes in Washington to pay attention to what was actually happening in one of the most structurally important commodities on the planet. Silver dropped 10.5% in a single trading session. Not a pullback, not a mild correction, a full-scale, single-day collapse. 9921 erased from its price in one afternoon, closing at $77.52 per ounce. Now here's what makes that remarkable. Every underlying structural argument for holding silver didn't weaken on Friday. It actually intensified, and yet the price cratered anyway. That contradiction is exactly what this channel exists to examine, because the gap between what the price does and what the fundamentals say is where every significant opportunity in commodities ultimately lives. Let me give you the raw data first, because this is Silver Dispatch and we do not work from headlines. Spot silver opened near $84 and closed at $77.52. The gold to silver ratio, the number that tells you how many ounces of silver it takes to purchase 1 ounce of gold, expanded from 53.6 to 58.9 in a single session. Gold itself declined 1.83%, settling at $4,564 per ounce. The 10-year Treasury yield closed at 4.59%. Breaching levels last seen in February 2025. Mining equities across the London Exchange bled heavily. Fresnillo plc, the largest pure-play silver producer on the FTSE 100, shed approximately 9% in one day. Anglo American fell 6.2%. Hochschild Mining declined 6.4%. Endeavour Mining dropped 6.6%. And simultaneously, the University of Michigan released its preliminary consumer sentiment reading for May, 48.2. That is the lowest figure recorded in the entire 74-year history of that survey, the most apprehensive American consumer ever measured in the data, and silver still fell 10%. This is the kind of dislocation that most casual observers scroll past without processing. But if you are watching this channel, you understand that the price action on a single Friday afternoon is not the story. It is a symptom. And the actual story, the one that requires context, historical data, and institutional awareness to read correctly, is something else entirely. What happened on Friday was not a fundamental collapse. It was a repricing event. And the distinction between those two things is worth every minute of the next 15. Stay with me, because this gets considerably more interesting from here. To understand why Friday happened the way it did, you need to go back 72 hours to Tuesday, May 12th. The Bureau of Labor Statistics dropped the April Consumer Price Index. Year-on-year headline inflation came in at 3.8%, above consensus, and the highest reading since May 2023. Core CPI, which strips out food and energy, printed at 2.8% on an annual basis. That was the opening signal. But here's where it gets interesting. 24 hours after that release, the same agency published the April Producer Price Index, wholesale inflation. Month on month, it advanced 1.4% against a consensus expectation of roughly 0.4%, the largest single-month wholesale gain since March 2022. The 12-month trailing PPI figure reached 6%, the highest level since December 2022. Core PPI, stripping out volatility, rose 1% month-on-month and 5.2% year-on-year. Critically, nearly 60% of April's PPI increase originated in the services component. That is the precise segment of the inflation data that the Federal Reserve monitors most carefully when calibrating monetary policy. 2 consecutive inflation prints, both hotter than expected, both arriving within 48 hours, rewrote the entire rate expectations landscape within 1 week. The CME FedWatch tool now assigns near zero probability to any Federal Reserve rate reduction in 2026. The probability of an outright rate hike by December has climbed to approximately 50%. 1 week prior to Friday's session, that hike probability stood near 16%. 2 weeks before that, markets were still pricing in 2 cuts for the calendar year. 30 percentage points of monetary risk repriced in 7 calendar days. Now, here's the mechanical connection to silver. And this is where most retail observers get lost. Silver generates no yield. It pays you nothing to hold it. When market expectations shift toward a higher cost of capital, toward tighter monetary conditions, the calculus against holding non-yielding assets becomes brutally direct. The paper selling on Friday was not irrational. It followed logically from those 2 inflation prints. However, and this is the distinction that defines whether you are a short-term trader or a long-term student of this market, the paper market and the physical market are not the same structure. Confusing them is not just an intellectual error, it is a financially expensive one. The COMEX registered silver inventory, the deliverable metal that underpins the entire futures complex, stands at approximately 79.88 million ounces. The delivery coverage ratio sits at 13.4%. That is the seventh consecutive month below the 15% stress threshold considered standard by analysts who monitor physical leverage. The paper market repriced on inflation expectations. The physical vaults did not move accordingly. Those two things cannot stay disconnected indefinitely. That is the entire thesis. On the same Wednesday that wholesale inflation hit its fastest pace in nearly 4 years, the United States Senate confirmed Kevin Warsh as the 11th chair of the modern Federal Reserve era, by a vote of 54 to 45. That is the narrowest confirmation margin in the institution's recorded history. The Senate Banking Committee had advanced the nomination on a 13 to 11 strictly partisan split, the first fully partisan committee approval of a Fed chair in that committee's history. Jerome Powell, the outgoing chair, will remain on the Board of Governors through January 2028, the first time in nearly 8 decades that a former chair has returned to serve on the board after stepping down from the chairmanship. What does this create? A two-chair dynamic inside the same institution. An unprecedented structural check on the incoming chair's early decisions, sitting one seat away in the same room. Warsh's first Federal Open Market Committee meeting is scheduled for June 16th and 17th. That meeting includes an updated summary of economic projections, the dot plot. The March dot plot still projected at least one rate cut for 2026. If the June version removes that cut entirely, or introduces a hike, silver's consolidation likely extends through the third quarter. The man now holding the chair publicly opposed quantitative easing when the Fed's balance sheet first crossed $4 trillion. He called for structural change at the central bank on the public record. The most prominent monetary hawk in the institution's recent history now leads it on the slimmest mandate in its modern era, walking into his first meeting with the hottest combined inflation data in nearly 4 years in front of him, while his predecessor observes from 2 seats away. That is the institutional context the financial press reduced to 3 sentences. However, this channel does not present a single-sided analysis. The bear case deserves a full hearing. Spot silver at 70.52 sits approximately 36% below its January 29th intraday high of 121.67. The Reuters analyst consensus for the 2026 average silver price is roughly $79.50. Broadly in line with Friday's close, suggesting the market may actually be near fair value rather than a discounted entry point. Photovoltaic silver demand fell 6% in 2025 and is projected to decline a further 19% in 2026 as manufacturers aggressively reduce silver content per solar cell. India doubled its bullion import tariff from 6% to 15% on May 13th, a direct demand shock to one of the largest price-sensitive physical buying markets on Earth. And the iShares Silver Trust recorded a single-session redemption of approximately $3.4 billion during February's turbulence, more than 6% of total fund assets liquidated in one trading day. The bear case is real. We present it in full, without softening it. Here is the structural data that a single trading session did not change. The London Bullion Market Association's Loco London Vault System, the largest physical silver pool on the planet, held 27,154 tons at the end of April, valued at approximately $64.9 billion. That pool has contracted by roughly 7,000 tons from its all-time peak of 34,346 tons, recorded in January 2021. A 5-year directional drain, continuing through April with no visible reversal. The Silver Institute's World Silver Survey, published April 15th, projects a global supply deficit of 46.3 million ounces for calendar year 2026. That would represent the 6th consecutive annual deficit formally entered into the public record. The Sprott Physical Silver Trust, which holds fully allocated London Good Delivery silver stored at the Royal Canadian Mint, continued institutional accumulation through the first quarter of 2026, even as the paper market was under pressure. Institutions with allocated physical exposure were not selling. They were adding. Now layer in the energy context, because this is the mechanical engine behind everything else. West Texas Intermediate crude rose above $133.50 per barrel on Friday, on track for a weekly gain of approximately 10%. Brent crude firmed above $116 per barrel. The Strait of Hormuz, the passage through which approximately 20% of the world's traded oil flowed before the conflict began on February 28th, remains operationally disrupted, processing roughly 20% of its pre-war daily transit volume, according to current reporting. Saudi Arabia has formally communicated to OPEC that its production has fallen to the lowest level since 1990. The International Energy Agency cautions that the global oil market could remain materially undersupplied through October, even if hostilities ceased this month. Before the conflict began, the Brent consensus for early 2026 was below $60 per barrel. It has been above $169 since Friday's close. That energy shock feeds the wholesale inflation data. The wholesale inflation data feeds the Federal Reserve repricing. The Federal Reserve repricing crashed the silver paper market on Friday, but the physical inventory data, the vault drain, the consecutive deficits, the delivery coverage ratio in the stress zone, none of that was altered by a single session's futures selling. Silver is up approximately 134% year-on-year as of May 15, 2026. The most cautious consumer in 74 years of recorded sentiment data is holding an asset that has more than doubled in 12 months. And Friday's 10% single session decline did not change the vault numbers, the deficit record, or the energy supply reality. Dislocations do not destroy structure. They redistribute conviction from those who react to those who understand. I'm OG Peter for Silver Dispatch. Pull every source yourself. Arrive at your own read. This is for education and discussion only, not personal financial advice. Drop your thoughts in the comments. See you in the next dispatch.